For decades, it's been seen as the bedrock of smart, simple investing. It's low cost, it's diversified, it's reliable. But what if this huge triumph of modern finance is actually quietly creating a ticking time bomb right at the heart of the global economy? Well, today, we're diving deep into the theory of the index fund bubble. All right, so let's just jump right into the big, provocative question that's driving this whole debate. What actually happens when literally everyone buys the S&P 500? Now, that might sound like a crazy hypothetical, but as you're about to see, we might be closer to that reality than you think. And look, we're not talking about some small niche trend here. We're talking about trillions, with a T, trillions of dollars. It's like a monumental river of cash that has flowed away from the old school active stock pickers and poured directly into these passive index funds. And that shift has fundamentally rewired the way money moves through the markets. So, to really understand the risk, we first have to understand the success story. Let's start at the beginning. How did passive investing go from this radical, kind of weird idea to the dominant force in all of finance? It all started way back in 1975 with something critics literally called Bogle's folly. John Bogle's idea of just buying the whole market was basically laughed at. But then through the 90s, with the rise of 401ks, it started to catch on. And after the 2008 financial crisis, the floodgates just blew wide open, which brings us to today, where passive investing absolutely dominates the entire landscape. So why did everybody jump on board? Well, the reasons are actually incredibly logical. For years, study after study showed that most active managers, the highly paid experts, couldn't even beat the market average, especially after you accounted for their huge fees. Index funds offered the exact opposite. You get market returns for next to nothing. They were simple, they were diversified, and they eventually became the default choice for millions of us in our retirement accounts. Okay, so that's the success story. But, and this is a big but, what if that very success has a hidden, dangerous side effect? Let's explore the case for a bubble. The absolute core of this argument revolves around this one concept: price discovery distortion. So in a healthy market, you have investors researching companies, digging into the fundamentals, and deciding what they're really worth. That process is called price discovery. But passive investing doesn't do any of that. It just buys whatever's on the list, automatically, no questions asked. Think of it like this. It's like a shopper being forced to buy a prepackaged basket of groceries, whether the apples are amazing or totally rotten. And this is where it gets really wild, because this creates a powerful feedback loop. Here's how it works. Step 1, trillions of dollars flow into index funds. Step 2, by rule, those funds have to buy the biggest companies in the index. Step 3, all that demand pushes those stock prices up, which makes them an even bigger piece of the index. And step 4, their new, bigger size in the index attracts even more automatic money. It's a cycle that can just keep inflating prices, pretty much regardless of how well a company is actually doing. And this chart perfectly illustrates the result: immense concentration risk. So many people buy an S&P 500 fund thinking, great, I'm diversified across 500 companies. But look at this. About a quarter of the entire index is concentrated in just a handful of mega-cap tech companies. Your diversified investment is actually a massive bet on the continued success of just a few corporate giants. And it doesn't just stop with concentration. The bubble theorists point to other huge systemic risks. For instance, amplified volatility. If everyone owns the exact same things, what happens when everyone tries to sell at the exact same time? You get a stampede for the exit. Then you have liquidity concerns. Liquidity is just a fancy word for how easily you can sell something for cash. The fear is that in a mass sell-off, there just won't be enough buyers, and the market could literally freeze up. And finally, you have capital misallocation. If all the new money automatically flows only to the biggest companies, are we starving the next great innovative company of the investment it needs to grow? Okay, so that's the scary part. But to be fair, not everyone is buying this doom and gloom scenario. In fact, many experts argue these fears are way overblown. So now, let's hear the rebuttal. So that first big argument about price distortion, well, the rebuttal is pretty straightforward. The argument is that while all that passive money is on autopilot, the active managers are still very much in the driver's seat. They're the ones doing the research, and if a stock becomes truly overvalued because of all these index fund flows, active managers will see a golden opportunity to sell it, which helps correct the price. They are the ones who ultimately set the prices that index funds just follow. Okay, but what about that scary concentration risk? Well, the counter-argument is really all about perspective. Yes, the index is top-heavy, but for the average person, owning a small piece of 500 different companies is infinitely more diversified and safer than trying to pick a few individual stocks on their own. It prevents people from putting all their retirement eggs in one or two baskets. And the fear of a market freeze-up, a liquidity crisis? Skeptics point out that the companies at the very top of the S&P 500 are the most traded, most liquid stocks in the entire world. Billions of dollars worth of their shares change hands every single day. The market and the structure of ETFs themselves are built to handle huge volumes of buying and selling. So, a financial triumph or a ticking time bomb? You've heard both sides. Let's take a look at what the future could hold and what this all means for your money. Now, if the bubble theory is correct, this thing wouldn't just pop on its own. It would need a trigger. And this could be anything, really, from aggressive interest rate hikes that make stocks look less attractive to a major geopolitical shock, or even just the top companies, the ones holding everything up, finally reporting some disappointing earnings. Any of these could be enough to shatter investor confidence and kick off a sell-off. And here is the anatomy of how that could spiral out of control and fast. A trigger event causes some initial losses. That leads to panic. As people start pulling money out of their index funds, the funds are forced to sell their holdings, all of them, to pay those people back. This forced, indiscriminate selling pushes the whole market down even further, which creates more panic, more redemptions, and a vicious downward cycle. And so, all of this brings us right back to where we started, to that massive central question. Is this passive revolution a genuine triumph that finally gave everyday investors a fair shot at building wealth? Or is it a collective blind spot? A huge systemic risk hiding in plain sight that we've all just kind of decided to ignore. For millions and millions of us, that is the multi-trillion-dollar question.